It's 11:47 at night, you're scrolling houses on your phone, and that same thought keeps popping up. How can something that costs hundreds of thousands of dollars turn into only a couple thousand a month? Then you tap the calculator, and it hits you with the part nobody likes saying out loud: 30 years. Look, you're not dumb for feeling weird about it. A 30-year mortgage sounds like you're signing up to be someone's employee until you're gray. Here's the simple truth. A mortgage is you renting a huge pile of money from a bank so you can buy a house today, instead of after 3 decades of saving. And once you get that, the whole thing gets way less mysterious. We're gonna keep it stupid simple. First, what a mortgage actually is in kid terms. Then, what your monthly payment is really made of. Finally, how to keep a 30-year mortgage from quietly draining you. Start with this. 30 years means 360 payments. Not magic. Just 360 monthly payments total. Picture this like you're 5. You want a giant toy castle that costs $400,000, but you've got like 20 bucks. So a grown-up says, "I'll buy it for you today, but you've got to pay me back a little bit every month, and you've got to pay me extra because I'm letting you use my money." That grown-up is the bank. The toy castle is the house, and the extra is interest, which is basically rent for the money. The bank's okay lending that much because the house is the backup plan. If you stop paying, the bank can take the house and sell it. That's why mortgages usually have lower rates than credit cards. So when you hear loan amount, that's just the part you didn't pay up front. If the house is $400,000 and you put down $80,000, you're borrowing $320,000. That down payment is you saying, "I'm serious," and it also makes the deal safer for the bank. Now, a common mistake right here is treating the down payment like some pointless fee you should always shrink. Sometimes that's fine, but sometimes a tiny down payment makes the whole deal way more expensive because it can add extra monthly costs and a bigger balance for interest to chew on. For now, lock in the kid-level sentence. You're buying a house, but you're also signing a 30-year money rental agreement. And that's where the rules change. When you pay cash, you mostly care about the price tag. When you borrow for 30 years, the price tag is only the beginning. The rate, the timeline, and your choices after closing can double the story. All right, so what's actually inside that monthly payment? Most people think their mortgage payment is one thing. It's not. It's usually a few bills bundled together. There's principal, which is the part that actually pays down the loan. There's interest, which is the bank's cut for lending you the money. And then there's often property taxes and homeowners insurance bundled in because the bank wants those paid on time. Sometimes there's mortgage insurance too, which is what shows up when your down payment is small. Let's do a clean example with roundish numbers. Say you borrow $300,000 at 6% for 30 years. Your payment for just principal and interest is about $1,800 a month. Here's the part that annoys people. In your very first payment, about $1,500 is interest and only about $300 is principal. So you pay $1,800 and your loan balance barely moves. That's not the bank being sneaky. That's just interest being calculated on a big balance. In month 1, you still owe basically the whole $300,000, so the interest chunk is huge. As the balance slowly drops, the interest chunk slowly shrinks, and more of your payment starts hitting principal. That slow shift is called amortization, which is a fancy word for the bank gets paid first. Another common mistake is thinking the bank front-loads interest like it's a separate fee. It's not a separate fee. It's interest on a big balance, and early on your balance is big. Now zoom out. About $1,800 a month for 360 months is roughly $600,000 to $48,000 paid out. On a $300,000 loan, that means roughly $348,000 was interest. Yeah, you can pay more in interest than the amount you borrowed just because time is long. Before you freak out, remember what you're getting in exchange. You're getting a house today, and you're spreading the cost across a timeline most people can handle. The whole point of the 30-year mortgage is flexibility. It keeps the required payment lower, which gives you breathing room when life gets messy. But flexibility cuts both ways. If you treat the lower payment like permission to max out your lifestyle, that same mortgage becomes a quiet trap. Now let's talk about the bundled bills part, because this is where people get blindsided. The payment you see on a listing is often just principal and interest, but your actual monthly outflow is usually principal, interest, property taxes, homeowners insurance, and sometimes mortgage insurance. So you might see $1,800 and end up paying $2,400 once the other stuff shows up. One of those other stuff line items is the weird one: mortgage insurance. This isn't insurance that protects you. It protects the lender. If you put less than 20% down, the lender's taking on more risk, so you pay a monthly fee until you've built enough equity. Even a small mortgage insurance bill matters. If it's $150 a month, that's $1,800 a year. If you pay that for 5 years, that's about $9,000. That didn't lower your loan balance at all. So if you're putting a small down payment down, you've got to ask how much mortgage insurance is and what the path is to getting rid of it. Another thing people miss is closing costs. On a typical purchase, you might pay a few percent of the home price in fees, prepaid taxes, and insurance. On a $400,000 home, even 3% is $12,000. That's why a low down payment deal can still need a chunky pile of cash up front. This week, take one home price you've been eyeballing and run it through a calculator that includes taxes, insurance, and mortgage insurance, not just principal and interest. If you only do one thing, do that, because it stops you from falling in love with a fantasy number. Back to the 5-year-old version. Every month, you hand the bank a pile of coins. Some coins pay rent for the money. Some coins buy a tiny piece of the house from the bank. Early on, most coins go to rent. Later, more coins go to buying. So, how do you win? You win by controlling 3 levers: how much you borrow, the rate you borrow at, and how long you keep the loan around. Borrow less, pay less interest. Get a lower rate, pay less interest, pay it off faster, pay less interest. But you also have a life, and you can't just throw every dollar at a mortgage and pretend food and fun don't exist. So the smarter question is, what's the best version of 30 years for you? If a higher payment would make you anxious, the 30 years is often better, because it gives you space. If you've got stable income, a solid cash buffer, and you hate interest with a passion, paying faster can make sense. The loan term isn't just math, it's behavior. Now, let's talk about the interest rate like you're 5. The interest rate is the price of renting the money. A tiny change in that price matters a lot when the rental lasts 30 years. Same $300,000 loan. At 6%, you're around $1,800 a month for principal and interest. At 5%, you're around $1,600 a month. That's roughly $200 a month difference. $200 a month is about $2,400 a year. And over 30 years, that 1% difference can be roughly $70,000 less interest. So when people shrug and say rates don't matter, they're missing the scale. This is why shopping your mortgage is one of the highest paid chores you'll ever do. Yet people will spend 3 weeks picking a backsplash and 5 minutes picking the lender. This week, get at least 2 quotes for the same loan amount and the same down payment, and make them show you the full estimate, not just a rate headline. You're not being annoying. You're buying 30 years of money. Now, back to the down payment myth. You've heard you need 20% down, like it's a law. It's not a law. It's a line that changes a couple things. At 20% down, you usually avoid mortgage insurance. You also borrow less, which shrinks the interest you'll pay over time. But a bigger down payment also means more cash tied up in the house. So the better question isn't, is 20% required? It's, what am I buying with a bigger down payment? Sometimes you're buying a lower monthly payment and no mortgage insurance. Sometimes you're buying peace of mind. Sometimes you're buying a tiny improvement that isn't worth draining your savings. Let's do a quick example. Same $400,000 house. At 20% down, that's $80,000 down. And you borrow $320,000. At 6% principal and interest is about $1,900 a month. At 10% down, you put down $40,000 and borrow $360,000. Now principal and interest jumps, and you might add mortgage insurance on top. That combo can turn a $1,900 payment into something like $2,300 or more. So a smaller down payment isn't bad, but it can make the monthly bill heavier than you expected. Here's a better approach than obsessing over the perfect percentage. Aim for a payment you can keep even if life punches you in the face. That means you can cover it with your normal income, still save something, and still sleep at night. Now, about that thing where early payments barely touch principal. Once you understand amortization, you realize something powerful. Extra payments early are worth more than extra payments late. If you send extra money to principal in the first few years, you shrink the balance while it's still huge, and that shrinks future interest. Same 300,000 loan at 6%. If you pay the normal amount, you finish in 360 months and pay about $348,000 in interest. If you add just $100 extra each month, you finish in about 313 months, almost 4 years sooner. And you cut interest by roughly $53,000. If you add $200 extra each month, you can finish in about 279 months, a little over 7 years sooner. And you save around $91,000 in interest. I'm not telling you to do that no matter what. I'm telling you the lever exists and it's big. And you don't have to think in extra every month terms. If you can manage one extra full payment per year, even if you split it up across months, it can take a typical 30-year payoff down into the mid-20s. On that $300,000 loan at 6%, adding about 1/12 of a payment each month can cut more than 5 years off and save something like $70,000 in interest. That's the same mortgage, just with a different habit. Here's a sneaky way people mess it up. They pay extra, but it doesn't actually reduce the balance the way they think. Sometimes it just pays ahead instead of paying down. You want the extra money to hit principal so the balance shrinks, not to prepay next month. Check your statement and make sure the balance dropped. Ask how your lender applies extra payments and confirm your balance drops accordingly. Rates, home prices, and your personal situation can shift fast, so you've got to run your own numbers before you lock anything in. Now for escrow, because it explains why fixed payments still change. Escrow is the bank collecting little chunks each month to pay your property taxes and insurance when those big bills hit. If your taxes go up, your escrow can go up. So your monthly payment can rise even if your interest rate never changes. That surprises people, and then they act like the lender raised the mortgage. The lender didn't raise the rate. The other bills moved. So leave wiggle room. Now zoom out to the life part. Owning a house comes with repairs, and those costs don't wait for you to feel ready. So if your payment eats every spare dollar, you're one busted water heater away from credit card panic. A better approach is treating the house like it has a small subscription fee beyond the mortgage. Even a rough rule like 1% of the home value per year for maintenance gets you thinking. On a $400,000 home, that's about $4,000 a year, or about $330 a month. Now, why would anyone ever choose a 30-year mortgage if it's so much interest? Because required payments matter when life's unpredictable. A 30-year mortgage gives you the option to pay extra when you can, and pay the minimum when you need to. That option has value. The mistake is using the lower required payment to stretch into a bigger house than you'd otherwise buy. That's when flexibility turns into pressure. Let's compare a 30-year and a 15-year in simple terms. On that $300,000 loan at 6%, the 30-year is about $1,800 a month for principal and interest. The 15-year payment is much higher, closer to $2,500 a month. But the total interest on the 15-year is way lower. The 15-year is paying more each month to escape faster. The 30-year is paying less each month to keep your options. Neither is morally superior. The right one is the one you can stick with without blowing up your life. A lot of people do a hybrid. Take the 30-year for the lower required payment, then pay it like a 15-year when their budget allows. You get flexibility and you still kill interest faster as long as you actually do it. Now refinancing and points, super quick and simple. Points are money you pay up front to buy a lower rate. Refinancing is swapping your old mortgage for a new one, usually for a better rate. The trap is lowering today's payment by stretching the timeline again and again. So you keep paying interest forever. So if you refinance, always ask, am I reducing my total cost? Or am I just extending the clock? This week, pull up your amortization schedule or a payoff calculator and see how much interest you'll pay if you keep paying the minimum versus adding a small extra amount. Seeing the gap in plain numbers makes your next move feel a lot less emotional. All right, 2 quick stories. Person 1 buys a house they can technically afford because the lender approved it and the payment barely fits. They choose the 30-year, but every month is tight, so they never pay extra. Taxes rise, insurance rises, and repairs hit. And now they're stressed and stuck. They didn't buy a home. They bought constant stress instead. Person 2 buys a slightly smaller house. They also choose the 30-year, but their payment leaves breathing room. So they round their payment up by $100 or $200 when they can. They still live their life, but they quietly shave years off the loan. When a surprise repair hits, it's annoying, but it doesn't wreck them. Same mortgage length. Totally different. This is why I don't care as much about 30-year versus 15-year, as I care about tight versus manageable. Manageable wins. Now, the big whisper question: is a mortgage good debt? It can be, but only if you don't let it bully you into overbuying. A mortgage is a tool. If you keep the payment reasonable, a fixed-rate mortgage can help you lock in housing costs while your income rises over time. But if you stack a big mortgage on top of other big fixed bills, you've got no room to breathe. So when someone tells you just buy as much as the bank approves, hear it as a sales pitch. You don't need to win the house. You need to win your life after the house. I've seen people get approved for a payment that eats close to half their take-home pay. Approval isn't comfort. Drop the payment by $500 a month, and that's $6,000 a year for savings or repairs. That's real leverage. Shrink it back down to the 5-year-old version. A 30-year mortgage is a long deal where you borrow a lot, you pay rent on borrowed money, and you slowly buy the house piece by piece. Early on, the rent part is big. Later, the buying part gets bigger. You can make it cheaper by borrowing less, getting a lower rate, or paying it off faster. You can make it miserable by stretching your budget thin and pretending taxes and repairs don't exist. If you remember nothing else, remember this: the mortgage isn't the enemy. The mismatch between the payment and your real life is. So if you're about to get a mortgage, ask yourself 3 grown-up questions. Can I still save money each month after this payment? Can I handle a bad month without instantly panicking? And if taxes or insurance jump, do I still have room? If the answers are yes, the 30-year mortgage becomes a tool you control. If the answers are no, that dream home can turn into a problem you wear every day. All right, here's the clean recap. A mortgage is renting money. Your payment is principal plus interest, and usually taxes and insurance too. 30 years is 360 payments. And interest is heavy at the start because you owe a lot at the start. You win by choosing a payment that's manageable, shopping the rate, and using extra principal payments intentionally when it makes sense. And you don't need to be perfect, you just need to be deliberate. Get the basics right and you'll stop feeling like the mortgage is a mystery monster under the bed. You'll see it for what it means: a contract with knobs you can turn. And once you can turn the knobs, you're the one in charge. If you want more money stuff explained in plain English like this, hit subscribe.